Okay, so today we're going to be doing the first topic on the Accounting Unit 2 syllabus, which would be, as you can see, is the Introduction to Cost and Management Accounting. Okay, so the subtopics are, as you can see on the screen, the role of cost and management accounting, where we would define the different types of accounting, define accounting as a whole, and we will also look at the uses of management accounting. And the second sub point there, you can see, is cost and management accounting. Okay, sorry for the background noise. Right, so as I said, the second sub point here is the cost and management accounting versus financial accounting. So there we would look at the similarities and differences between the two branches of accounting. Okay, so let's start the lesson. Right, so a review. In essence, there are two broad categories of accounting, namely financial accounting and management accounting, where the latter usually includes cost accounting. So you can see the two images there. All right, so then we have the role, so the first subtopic, so the role of cost and management accounting. But before I start this, let's go back to the previous slide. As I said, the two branches of financial management. Well, usually I would say, I stand corrected. Um, the first one, which would be financial accounting, is the more well-known one. When people think of accounting, they usually think of spreadsheets and the balance sheet, income statement, yada yada yada. But there's another branch which I would say is lesser known, at least to the common person, which is management, which is the focus of the syllabus. Okay, so management, as we will see, is a lot different from financial, which we will get into. Okay, so back to the lesson, right? So the first definition I have here is accounting. So we're going to define accounting as a whole, as a discipline. So I have accounting may be defined as the process of identifying, measuring, and communicating financial and non-financial information to permit informed judgments and decisions by the users of accounting information. Okay, so you should know the accounting process. We will start with the source documents, and then you would then extract important details from the source documents and post those to the journal, and then record those in the journal and post them to the ledger and prepare your trial balance, so on and so forth. So basically, but this is more, that would be more so on a financial view of it, the accounting process. Um, but essentially, yeah, you use financial and non-financial information, because the whole point of all of this, gathering all this information, analyzing it, and so on and so forth, is to permit the users of accounting information to make informed, keyword informed, decisions. No matter who they are, internal, external, you can make informed decisions. So the information we present to them must be accurate, it must be faithful, and so on and so forth, so they can make the best decision possible with the information we present to them. Okay, because these decisions they make can favorably or unfavorably affect themselves and other groups and other stakeholders to the business. Okay, so next definition I have here is management accounting. Now, I define management accounting as um, focusing on the process of identifying, measuring, accumulating, analyzing, preparing, interpreting, and communicating information used to plan, evaluate, and control the use of and accountability for the entity's resources. So that's a mouthful. So essentially, what this is saying, right, is that the key basically, you as the manager, you're gathering financial information and non-financial information. You're doing all these things and you're going to use them to maximize the use of the entity's resources. That's essentially what it's saying. Okay, so you're not only focusing on the financial aspect, but you're also focusing on the non-financial aspect. Okay, and of course, managers have different functions. They plan, so they will set goals for the business. They evaluate these goals by making sure they put mechanisms in place to ensure these goals are met. And if they fall short, they will have mitigation policies or whatever in place, as well as controlling. They can also directly control the processes using this information, so they know if they need to make a particular area more efficient or so on and so forth. Okay, 1 second. Okay, sorry about that. Right. Okay, so we move on to the next set of definitions. Okay, so now we have cost accounting. So I define cost accounting as focusing on the techniques for determining the input cost of a project, process, or an item through the direct measurement, arbitrary assignment, or systematic and rational allocation. So basically, cost accounting basically is self-explanatory. It focuses on the costing of, as it listed there, projects, processes, or items, products, whatever have you, of a business. Basically, costing and how you would, the mechanisms and strategies you would use to cost these items. That's basically what cost accounting is focusing on. And the last definition I have here is defining financial accounting, which you should be familiar with. If not, there's a definition. So I define it as the process of recording, estimating, organizing, analyzing, and summarizing monetary, keyword there, monetary, transactions for the use in the preparation of financial statements based on the consequences of past events. So there's a lot to pick apart here. So we have monetary transactions. If you recall, there is a concept or restraint, I'm not sure which one it is, but it's called the monetary unit, which states that economic events only record economic events that can be expressed in a currency, whether it be dollars and cents or yen, whatever have you. It has to be expressible in a monetary sense. It has to be expressible in monetary terms. So monetary unit. And preparation of financial statements based on past events. Because if we recall, we can only account for in financial accounting for events that have already happened. So if we made this amount of sales this year, if we made this amount of purchases, if we owe this person, whatever have you. So as long as it is a past economic event with a monetary and it can be expressed in monetary terms, then we should record it as long as it is affecting the business in some way. Okay, so those are our definitions. Now I have the uses of cost and management accounting. So I have 5 listed here, and this is by no means an exhaustive list. These are the 5 probably most common uses. So the first one I have listed there is product slash service mix. So basically that is determining which products and services to sell or provide. So a business can have a variety of products and services that they provide. So they could maybe have certain products offered at only certain times of the year. For example, seasonal offerings like around Christmas. You only, well, you should mainly see Christmas decorations, and so being offered around Christmas time. It would make no sense when it's offering it any other time of the year, for instance. So it's like a product mix slash service mix can always change. So they information provided by cost and management accounting helps them to determine their product slash service mix. The second use I have here is product costing. So I think that one is self-explanatory, but I also give a definition here. It is allocating costs incurred to goods and services. So as we said before, one second again. Okay, right. Right. So product costing. So basically, while creating goods and providing services, businesses will incur costs. So in order to once again allow um, informed decision making or permit informed decision making, we have to allocate costs to the goods and services which generated these costs. Okay, and we have to do it so accurately as accurately as we can, because there are going to be some costs which we can't directly trace to the goods and services which generated them, but that will be covered later on in the syllabus. The third use I have here is price determination, which is setting, as it says there, setting prices for jobs, products, and services. So that's self-explanatory again. So costing and pricing is two different things. Cost is the expense to us to provide the services, to create the goods, but the price is what we're going to sell them at. So we basically, that's the information provided by cost management accounting will allow us or permit us to set prices according to whatever policies we have in place. So price setting is basically what that is saying. And the fourth use I have here is acquisition of production capacity. And I have here the maximum level of output possible. Okay, So basically, businesses will have differing capacities, basically how much goods they can produce within a certain time frame, um, according to their size and technology they have available, so on and so forth. So the accounting information provided by this particular branch can help us determine what our production capacity is. And you may not think that's something important, but let us think that we don't forget managers have to budget in advance of the period for what they plan to do or the goals they want to achieve. So we cannot, if managers don't know or don't have an accurate estimation of their production capacity, they will find themselves in trouble. Because let's say a manager budgets that they want to create or sorry produce 100,000 units of goods, and if they don't know the capacity, let's say the capacity is only 60,000, then they would have a shortage because they can only actually produce 60,000 in the time frame, but they wanted to produce 100,000. Or vice versa. If he wants to produce 100,000, but he is actually producing 120,000, then that would also be problematic because he will not have allocated the things in place to accommodate so much goods. So they need to know their production capacity so they can best set goals and budget for the period ahead of them. Okay. And the last point I have here is evaluating business activities. So before I mentioned setting goals. So what's the point of setting goals if you don't make sure that you keep on track or that you achieve them? Because goals are things you plan to achieve. So we have here planning goals and ensuring that they are achieved. So we need to make sure at the end of the period we look back, we compare or evaluate keyword, compare what we actually our actual performance against our budgeted performance. So a favorable outcome would be, of course, if we matched or surpassed what we budgeted to perform. Of course, an unfavorable outcome would be if we underperformed, if we didn't do as well as we thought we would do. For instance, if we wanted to make $50,000 in sales, but we only made 30,000, that would be unfavorable. We need to look back now and determine, okay, why did we have a dip in sales? Was it that the prices were too high, whatever the case may be? So then they'll have to look back now and try to identify the causes of these inefficiencies or efficiencies if they did better than they thought, and they would either correct the inefficiencies or reinforce the efficiencies respectively. Okay. All right. So the next thing I have here. So now we're at the second subtopic where we're going to be comparing and contrasting cost and management accounting and financial accounting. Okay. Excuse me. All right. So the first slide here we have is similarities. And I have three similarities. So the first one is that both of them, both branches of accounting, are used to report the economic transactions of a business. So they both this one is self-explanatory once again. So for instance, if we bought this amount of raw materials and we created this amount of products, that is an economic transaction. If we made this amount of sales, if we bought this particular asset on account, those are also economic transactions. And one way or the other, both will have interaction with these economic transactions, and they both report them. They may report them differently, but they both report the economic transactions of business. And the second similarity I have here is the evaluation of a business's performance for decision making. Once again, users of account information need accounting information to make decisions. It's all about facilitating decision making, accurate and informed decision making. So once again, evaluating business performance. For instance, in financial accounting are the financial statements. Income statement will tell you, okay, how much profit we made for this particular period. Balance sheet will tell us, okay, this is what assets we have, this is what liabilities we have, so on and so forth. Okay, so this would help us to evaluate, okay, how well or how poorly our business has performed, and we will need to uncover why it's performing so well or why it's performing so poorly. Okay, and same thing for management accounting. For instance, the same example I gave earlier. If we wanted to reach this amount of sales but we weren't able to, we need to determine why that was the case so we can correct the problem before it gets any worse. Okay, so they're both used to evaluate business performance decision making. All right, and the last similarity I have here is that they utilize similar accounting methods, statements, and systems. Example, the accrual basis of accounting. So both financial and management accounting utilize the accrual basis of accounting. But there's other examples you can have here. They will both interact with the financial statements in some way. Um, they may not, one may be more involved in the preparation process. As in, for example, financial will be more involved in the actual preparation of the financial statements, but cost and management accounting would also have a relationship with that as well. Another example could be accounting method depreciation. Depreciation would also be factored into, for instance, costing. So all of these things are common between both branches of accounting. So they both utilize similar information. All right, so that's the similarities between two branches. Now we have the differences. I can say that there is more differences between the two than there are similarities. Once again, this isn't an exhaustive or extensive list by any means. It's just like the more prominent ones. Okay. Okay. So the first row I have there are the users of accounting information. So we referenced the users of accounting information before, but who are these people? Internal versus external. The management accounting caters to the internal users, and as I have there, including all levels of management and department heads. So all levels of management and department heads throughout the organization, business organization, will have access to the information provided by management accounting. Once again, to facilitate decision making. Okay. And whereas for financial accounting, they cater primarily to external users. And I have examples there, including creditors, regulatory agencies, and investors. They would need to use the financial statements and other information provided by the financial accounting system to, once again, facilitate decision making. Creditors want to know the business can afford to settle their debts in a reasonable time so that they can continue to do business with them. Um, Regulatory agencies would like to know that the business is cooperating with the relevant laws and policies and standards put in place. And investors, of course, would like to know if, well, there's this CB2, there's current investors and there's potential. So the current investors would want to know that their investment is reaping rewards, is receiving returns on their investment, make it so solidifying that their investment was worthwhile. Okay, and a potential investor would like to see the prospects of the business so to make their decision as to whether they would like to come on board and invest in the business as well. Okay, and the next row I have here is time focus of reporting. So I have here under management accounting, I said that management accounting uses historical and future data like records, financial records, and budgets, respectively. So management accounting looks at both. They'll look at the accounting records, but they'll also prepare things like budgets and forecasts, financial statements. Once again, for planning purposes, they utilize both in their information system. Whereas you have a financial accounting, it only uses historical information for reporting. So they can only report on what has happened. So historical information. Okay. And the third row I have here is type of information used. So under monetary accounting, I have that it uses monetary and non-monetary information with emphasis of objectivity and verifiability. Okay, so monetary information, dollars and cents, whatever have you, whatever currency, but also non-monetary information. Okay, so number of units produced, the cost of it can be expressed in monetary terms, but the number of units um, can't be, or the number of unit sales, that can't be expressed in monetary terms directly. It can be costs associated with it, but not directly. So this is just a few examples. There's more examples of non-monetary information. For instance, management accounting, they have to make sure that during the production process that they minimize wastage as much as possible. So that's another thing they have to take into consideration. And wastage and pollution as well. They need to make sure that whatever processes they undertake, that they minimize wastage, they minimize pollution, They would also consider political factors, technological factors, social factors. There's a number of non-monetary information that management accountants need to take into consideration. Okay, and in the under financial accounting, I have that they only use monetary information with emphasis of relevance and consistency. For instance, relevance would be relating to the timeliness of the information, the timeliness. So you can't expect to present the users of a combination um, with information relating to a period 10 years later, because by that time they would have already made up their minds, things already happened in place, and that information would be obsolete. So timeliness is very important, well, in both branches, but especially in financial accounting. And the consistency, that speaks to the, well, not to use back the word consistency, but how consistently you are using um, or sorry, preparing your statements and so on and so forth. So however you conduct your system, your company system, one period should be the same as the period before it and the period after it. This is of course to ensure comparability, not only with past periods of the same business, but also between businesses. So you want to compare your company with a competitor. You need to make sure that your stuff is consistent with not only your previous periods, but with them so that you can make meaningful comparisons so that you aren't comparing oranges with apples. Okay. And the next row I have here is type of reports. So we're looking at the different kinds of reports that each one uses. Um, so management accounting, I said that it uses detailed segmental reports about departments, products, or customers, whereas with financial accounting, they utilize summarized reports about the whole business. So I think it's pretty self-explanatory. So the management accounting reports is more detailed, it's more information, so to speak. Whereas financial accounting is summarized for the whole business. Okay, and for instance, the management accountant may want to focus on a particular customer or product line to determine whether they should drop the customer, drop the product line, add a product line, revamp a product line, whatever have you. Look at a department to determine if it's performing efficiently, if it's doing everything it's supposed to be doing to meet the plans and the goals of the organization, so on and so forth. Okay, and lastly, last row I have here is the report requirements. Um, so I have under management accounting that it is not mandatory and it's not required to follow GAAP, which stands for generally accepted accounting principles, or any other related standards, so like the international accounting standards. They would apply to the management accounting because it is something internal. It's me used as a tool to facilitate decision making by the managers and whoever is internal to the business. However, now, financial accounting is in fact mandatory and must follow generally accepted principles in addition to other standards, as I said before, like IFRS, International Financial Reporting Standards, IAS, the International Accounting Standards, whatever have you. So they have to abide by certain rules, um, and so on and so forth, and standards. Okay, so those are the differences they have here. So I'm gonna go on to the next slide. Okay, so that will be the end of the lesson. Just have some few review questions here. So as it says, in your own words, define cost and management accounting. So as we said before, cost and management accounting is the process of gathering and analyzing. In my own words, I'll just define it as gathering and analyzing non-financial and financial information in order to optimize or maximize the use of an entity's resources. Okay. Um, the second question we have here is describe three uses of a management accounting information. So we said it's used for price determination, so setting prices of your products and services. We have product costing, so allocating costs to these products and services, as well as I said for um, evaluating business activities. So making sure that the plans and goals set for the business are met and making sure mechanisms are in place for favorable and unfavorable outcomes. And the last one I have here is outline two similarities and two differences between financial and management accounting. Two similarities, as we said, that they both report on the economic transactions of businesses, right? And a second one could be that they both utilize similar information. For example, the accrual basis of accounting. And two differences would be that the types of users, for instance, management accounting caters to internal users, for example, management or levels of management, whereas the financial accounting caters primarily to external users, for example, investors, creditors, regulatory agencies. Um, and um, another difference would be that one is mandatory, the other is not. For instance, management accounting is not mandatory and is not obliged to follow any standards or anything of the sort, whereas financial accounting is. It has to follow GAAP, it has to follow international standards. Okay, and I have three multiple choice questions here on the last three slides. So number 4, I have that financial accounting provides a historical perspective, whereas management accounting, and we have 4 options. A, we said, enables managers to make accurate decisions. B, emphasizes a current perspective. C, emphasizes the future in addition to historical reports. And D, allows the use of GAAP. Okay, so let's do a process of elimination. We said previously that management accounting is not required to follow GAAP, so it cannot be D. It cannot, it is correct. It does allow managers to make decisions, but it isn't the best answer for this question. Neither is B. So I would have to say the answer is C. Okay? Because if you look at context of the question, it's looking at the time focus of financial accounting. It says historical perspective. So we have to look at the answer will have to be the time focus of management accounting, which is, as we said, it utilizes historical information, the financial statements, accounting records, as well as future information, such as the forecasts, financial statements, you have the budgets, and so on and so forth. Okay. Now we have question 5. So we said that it says the users of cost and management accounting are stockholders and suppliers, managers and supervisors, government agencies. So our options are A, I only, B, 2I only, C, I and 2I, and D, I and 3I. So once again, by process of elimination, we know that the users of accounting information are internal, which means it cannot be I because suppliers are external. Suppliers could be the same thing as creditors, they're external, and so are government agencies. Government agencies are external. So it would have to be B, 2I only, because managers and supervisors will fall under the category of internal users. And so yeah, that's the answer for this question. And the last question I have here is that management accounting information helps managers to plan and control operations, investors to make decisions, 3I creditors to extend credit. Once again, we have to look at which type of users of accounting information use management accounting. So it cannot be 3I because creditors, as we said before, are external, and so are investors. So it would have to be I only. So the answer is A. It helps managers to plan and control operations. Okay, so that is the end of the lesson. Just to recap what we have done. Right, so today we looked at Introduction to Cost and Management Accounting, which is the first topic on the Accounting Unit 2 syllabus. We went to the subtopics of the role and cost and management accounting, where we defined accounting as a whole. We defined individual branches, management, cost, and financial. We also looked at the uses of cost and management accounting. We went through 5 uses. And the second subtopic we looked at the similarities as well as the differences between the two branches of accounting. Okay, so that is the end of the lesson.